All right. Today our topic is going to be leveraging capital structure. First, we will start with the break-even point. Okay, break-even analysis we will start with first. So now, let me explain you what this break-even thing is all about. Okay. Some of you must already know by this time that break-even meaning here is that there will be no profit, no loss. There will be no profit and there will be no losses. That's what break-even analysis is about. Okay. And so how it can happen? It can happen when your sales revenue will be equal to your total cost. Okay. How it can happen? Your sales revenue will be total to your sales revenue will be total equal to your total cost. That's how it's gonna happen. Okay. So let's have a look. No. All right. So let me I wanted to actually do these ones in here. Control and a new page. I want to take it here and I want to draw it by myself. Okay. How it works. So I will say here that total cost is equal to, I don't know if you guys can see it, I'll make it bigger. Total cost is equal to fixed cost plus variable cost. That's how we calculate our total cost. Now, what is fixed cost? Fixed cost is the cost that you must have to pay regardless of your production volume. It doesn't matter how much you produce, no matter at all, it doesn't matter. Regardless of your production volume, you must have to make the payment. For example, let's say if you make a high volume of production, okay, then what happens? Your some expenses will be high, some expenses will remain the same. For example, manager's salary. Doesn't matter how much you produce, manager's salary will always remain the same. If you produce, if you don't produce, doesn't matter. That's fixed cost. And variable cost is your cost that varies with production level. Cost that varies with production level. That's variable cost. How it can happen? For example, let's say you need to produce something. You need raw materials. What do you need? You need raw materials. The more you produce, the more raw materials you need. Make sense, guys? The more you produce, the more raw materials you need. Okay? When you need more and more raw materials, your expenses will be high. So variable cost is related with your production volume. Okay? Good. Now, what happens with our selling price? SP, that is your selling price. Okay? Selling price. Now, let's say your fixed cost of an item is, for example, let's say $200,000. Okay? And your variable cost is actually, let's say, your $50 per unit. And your selling price is again, let's say selling price is, let's say, for example, $90 per unit. Okay, $90 is selling price. How are you feeling? Good? Fixed cost, 200,000. Variable cost is 50, but you're selling every item as $90. So now you see, if you sell one item, when you make a sale of one item, how much profit you make? If you sell one item, so now you say sell one item, one unit, okay, is equal to, you say, how much revenue you're gonna get? You're gonna get a revenue of $90. How much is the costing here? We don't know. We know how much total cost of this item. We don't know, to be honest. We know variable cost, but variable cost is not your total cost. Another part is left. Total cost has these things, you see? Total cost. See? Total cost is your fixed cost plus variable cost. So we know the variable cost, but we don't know the fixed cost of that unit. But if we know how much the farm is producing in total, then we know. Again, we will know only average fixed cost. We will know. How are you going to know average fixed cost? We're going to divide it by how many units has been produced. Now the question comes up, most of the corporations, most of the entities, they get confused. What they get confused about? They get confused about how many items to produce actually. So you might think, okay, well, that's the actually job of marketing team. Sales department will decide how much they can sell. That's what you're going to produce. Not necessarily 100% true. It is true, but not necessarily we're going to rely on solely on the sales team. No, not necessarily. We have to check how many items we need to sell to reach to our production, break-even level. And we have to push our sales department. You have to make this much sales, otherwise we cannot reach to our break-even point. Make sense, guys? Okay. Now, how do we solve this problem? We solve it this way. Look at this. If you sell this one unit, your revenue is $90, but your variable cost here is $50. This is not your profit. So what's the difference between these two? It means to produce this item, you had a cost of $50. But you sold this item for $90. So how much you actually got extra? I will not do that. I will just say this is here is $40 you got extra. How did you get this $40? $40 you get from here, selling price minus variable cost is equal to 90 minus 50. $40. That's the story. Okay. This is your situation now. This $40, what do you call this $40? This $40 we call it as contribution. This $40 we call as contribution. Interesting part here is this. You know what? Now you got $40, right? This $40. Now look, when you make one sale, you sold it for $90. But look, you covered only $50, the variable cost of that unit. But you now still have to pay off this fixed cost. How much is that fixed cost? $200,000. Now how much you got now? $40. This $40 will be used as a contribution to cover your fixed cost. See? Name says it all. $40. So like this, so how many units you need to sell to cover this fixed cost? So this $90 will be covering your variable cost, plus it will cover $40 from the fixed cost. To sell another unit, you sell 2 units now, then what happens? 2 units, revenue will be $180. Variable cost is $100 for 2 units. Now you have $80 contributed, you see. So every unit you sell, you have $40 you're contributing towards paying your fixed cost, recover your fixed cost. All right. So how many units you need to cover this full fixed cost? So we will say that we'll call that as break-even point. Okay, that is actually equal to, I'll do it now. Okay, break-even point is equal to, let's go in here, we say this way, fixed cost divided by selling price minus variable cost. Remember one thing here, guys. Top one is total fixed cost. Let's write it down here. Total fixed cost, but here, this is selling price per unit. And variable cost, oh no, per unit. All right. So you have to understand these things. Okay. Selling price per unit and variable cost per unit. So in our example in here that I gave you just right now, so it's gonna be what? Total fixed cost is how much? $200,000. And you go here. Selling price per unit is how much? $90. $90. And variable cost per unit is $50. Okay. So how much you got here? So this one is known as contribution. Remember this one, guys. This item is known, this is known as, I think I should do it in here, then you will understand it better. Divided by okay. This is the thing. So contribution means selling price per unit minus variable cost per unit. And the answer will be here, will be equal to 40, 200, yeah, it will be 50,000 units. Oh, 5,000 units. It's going to be 5,000 units. Okay, the answer is in units. All right. That's the break-even point. Now, if you calculate this one, if you calculate these things for true story, look at here. So how much is your total fixed cost? How much is total cost actually? Total cost is equal to total fixed cost plus total variable cost. I should write it down here. Total cost, total fixed cost plus total variable cost. It's not only just variable cost. Okay, so how much is my total fixed cost? Fixed cost is fixed regardless of how many units I produce, doesn't matter. Okay, so this is $200,000 plus total variable cost. Variable cost will be how many units you produce and how much is per unit. Okay, so it's gonna be actually how much units you producing? 5,000 units you producing now. 5,000 units you producing, and this 5,000 units will be multiplied by each unit by how much? Sorry, variable cost is $50. $50. Okay. So how much in total? In total, it will be 250. Yeah, 250,000 plus 200,000, $450,000. The $450,000 is your total cost. If you sell these 500 units, okay, I should write down here. Okay. If you sell this 5,000 units, how much you getting as your revenue, total revenue? Total revenue. Total revenue is equal to how much? Total revenue will be again this. 500,000 units into each item is $90. So you see here now is equal to again your $450,000. Okay. You see now your total revenue is actually your total expense, total cost. Okay. Total revenue is your actually total cost. So what is your profit here? No profit, no loss. This is called break-even point. Any question for me here, guys? Any question? I don't think so. It's very simple concept. It's not very tough one. Okay? Very simple concept. Okay, so I think I'll keep them all in terms of equations actually. So this is our equation in here. All right, now these things you can show it in diagrammatically. In a diagram, how are you gonna show these things? Okay, I would actually like to use here freehand drawing. I'm gonna use now. They have, yeah, we have that whiteboard, but I will use paint. 3D. I think this is the one. No. Oh gosh, why is it too small? Okay, so let's take the pencil and we're gonna actually so this is, oh my God. Oh wow. Oh, it's because I put distance. I leave it. I'll use it because the problem here is that whenever I go for use whiteboard, I have to actually share separately. That's why I try to avoid a whiteboard actually. Okay, anyway, I'm gonna write in here anyway. So now this is your y-axis, this is your x-axis, okay? And we are going to draw here your variable cost. Variable cost will be this one. Let me change the color. I'll give different types of colors here. This one, let's say, is variable cost. Variable cost will go, so okay, this side will be known as units. Let me write it down here, otherwise you guys will get confused. Units, and this side will be known as, let's say, dollar or output. I will say a dollar sign. Okay. All right. Now, so your variable cost is this. It's variable cost. Okay. Why this line? This line because if your units increases, so look at here, this line says if your unit increases, okay, if your unit increases, your variable cost increases. So look, if you increase in here, now this thing I'm going to delete actually after some time, but I just want to show you here. If you produce this much, for example, you produce in here, okay, then your costing is in here. If you produce less, then what? Let's say producing in here, produce less, then your expense will be also less. See, that's what I try to prove. So it means that if your production goes higher, your costing will go higher too. Okay. And then your fixed cost. Let's draw our fixed cost in here. Let's say this is your fixed cost, for example. No. I want to change the color. This is fixed cost, for example. So that's your fixed cost. Okay. I want to write it down here. That's your fixed cost. Okay. Can I change this color to this? Okay. What will be our total cost? Total cost will be combination of fixed cost and variable cost. So total cost will be actually starting from here. So this is our total cost. It will be exactly, I think I'll try to actually give the same. You cannot copy this, right? Anyway, it doesn't matter. I'll draw one. Do you think it's very parallel? I think it's almost not that bad. This is your total cost. Okay, so let's write it down, text. Total cost. No, I want to change this color again. Okay, let that be color, that's okay. That's total cost. This color. Okay, total cost. Now, we are going to actually calculate our total revenue now. This, I'll take the green line. Green one. These will be your, for example, let's say this will be your total revenue. Okay, this will be your total revenue. So let's write it down, text. This is your, total revenue. Total revenue, variable cost. Oh, no. Stay there. I need to move. Total cost. Yeah. So now, the question now is, where is our BEP? BEP is in here. I want to put BEP as which color? Blue. So this is our BEP. This is the exact point. This is our break-even point. Why this is break-even point? Where total revenue and total cost is same. That is our break-even point. Okay. So these many units we have to produce, break-even units. And how much? This is our how much. How do you get this number? Just multiply the numbers. Multiply the units, that's it. Is this thing clear to you guys? What did I draw here just now?
Yeah.
Good, thank you very much. Okay, this is your diagram for break-even point. Most of the books you will find that they don't want to show you this variable cost most of the time. They don't want to show the variable cost. They show the total cost, total revenue intersection here. So this is why I showed you this variable cost, total cost should be parallel line, because look at 0 point. How much is variable cost is your 0 at 0 point here. Look at this point, variable cost is 0. I say here 0. Wow. So the 0 point. Here, variable cost is 0. But we are still paying our total cost, fixed cost. That's why total cost will start from here. Remember that. But then it will, and look at this point. This much is your fixed cost. The rest of them is your variable cost. Okay. Okay. I am not much, actually I take this one. So I will say, and I want to take the color. Let's say yellow color. It may not be very, this much is variable cost. And down, this much is fixed cost of this blue line. Okay. Yes. Okay, this much is your variable, total variable cost here. Okay. All right, let me go back. Let me go back to my book again. The new share, screen share, share. Okay, so this is the, not this, sorry. What is my 13? So that's what I try to explain you in here. So here they give an example to you in this situation. Calculate the break-even point for two situations. Okay, for mode A and mode B, two mode. What they said here is this. Let's insert tables. Actually, two of them. Okay. So this is for mode A and this is for mode B. Two of them. Okay. So mode, this is your fixed cost. This is variable cost. I need another one. And this is my selling price per unit. Okay. For for mode A, they said our fixed cost is fixed cost of 30,000. Okay. Fixed cost 30,000 for mode A. And what else we have? Mode B is 80,000. Okay. Mode B is 80,000. And variable cost is how much? $50 selling price for both of them. $50. Both the item is selling at $50. What about the variable cost? For mode of operation A, variable cost is 40, B is 30. So this is 40 and this is 30. So this is the information we have in here. Okay. I did this table so that I don't have to go back again and again and check. That's annoying actually. Yeah, okay. So yes. So we know our mode A, mode B. Okay. If they use mode A, their fixed cost is 30, mode B, their fixed cost is 80. And you can see here the situation, these things. And what they did, okay, now it's better. They asked you to calculate break-even point. Is it tough? No. 30,000 divided by 50 minus 40, 10, 3,000, simple. 80,000 divided by 50 minus 30. So 50 minus 30, 20. 80,000 minus 20 divided by 20, 4,000. Done. Piece of cake. And they showed these things on here. Look at here. So here you can see. So this one is your total revenue. This one is your total cost. Easy. Okay. That's what they shows. For mode B, exactly. I showed it already. I just showed you on the they call it what? Smart board. Okay. Whiteboard. Okay. All right. Now let's move on to the next one. Now, next topic we're going to discuss is about risk and leverage. Okay. Risk and leverage. What is this? Okay. So what is the risk? Business risk is the risk of the firm being unable to cover its operating cost. This is operating risk as well. When we studied our risk chapter, we studied this thing, operating risk as well. Okay, it says business risk is the risk of the firm, risk to the firm being unable to cover its operating cost. This is business risk. Second one, we're talking about operating. What is operating leverage? If you can increase the sales volume and thus you can increase the EBIT, that is called operating leverage. You use your fixed cost in such a way that your sales increases. As a result, your EBIT, what is EBIT? Earning before interest and tax, increases too. Okay? Yes. All right. And this is an example they gave you. You put illustrations in here. All right. This is an example they gave. Let's look at the example, what they want to say. Let's check. So the same here, recall the XYZ, the same company, mode A30, same thing in here. So let's bring up the table. The table we just created, let's bring it up. Okay. Oh, they already have it here. So they're trying to show you here that if you increase your sales, okay, what's going to happen? Your earning per share and your earning before interest and taxes, EBIT and EPS will be changing too. EBIT and EPS will be changing as well. Okay. So they showed you units sold. At first they showed if you sell 3,000 units, if you sell 3,000 units, your sales revenue is $150,000. Operating cost is $150,000 as well. Why? Because $30 is your, look at here, $30 is your, sorry, 3,000 is your break-even point. Okay, the break-even point also this. So they mentioned it here actually. Fixed cost is 30,000, variable cost is 40,000. So 40,000 multiplied by 50. Okay, and this is your fixed cost. Okay. So how many units you're gonna sell? 3,000 units into a variable cost is 40. 3,000 into 40, 120 plus 30,000 fixed cost. Total cost is 150,000. And revenue is also 150,000. Your EBIT, 0. Earning after tax, 0. EPS, 0. If you sell 4,000 for the same thing, if you go in here for 3,000 units for mode B, look, 3,000 units multiplied by 30, 3 into 30, 90,000 plus their fixed cost is 80. 90 plus 80, 170,000 is their operating cost. Operating cost, they mean here total cost. Okay. So as a result, their business is actually going for a loss. EBIT is minus 20,000, earning per share is minus 140,000. Okay. And in here, the next point is 4,000. EPS is 7, but here EPS is 0. 5,000. They're showing you here that if you increase your sales volume, your EPS and EBIT will be increasing too. That's what they're trying to show you here. That's it. And another topic you need to discuss here, which is called as operating leverage. Like I said, operating leverage means the potential use of your fixed operating cost. You use your costing, but you use costing so efficiently, you use it. Okay, you use it in so efficiently that you will make a profit. EBIT will be increasing, EPS will be increasing. Okay. All right, now they got degree of leverage. How do you calculate degree of leverage? Two ways you can calculate it. One is percentage change in EBIT, and the one is here. Another one is in here. Two equation. You can use any one of the equation. It's all good. Depends on what information available to you. Okay. You can use any one of them. It's all right. And this says here, look at this one. Oh gosh. Okay. Percentage change in EBIT, the other percentage change in sales. That's it. Percentage change in EBIT divided by percentage change in sales. Okay, that's your equation. Okay, percentage change in EBIT and percentage change in sales. Done. Or revenue. And here is another example is in here. For this one, Q into P minus VC. So price minus variable cost is contribution into quantity. So it means total contribution. Okay, this says here contribution. Price minus variable cost, that's your contribution, right? Per unit. Multiply by quantity, that means total contribution. Divided by total contribution minus fixed cost. Okay, profit. Also contribution divided by profit. That's the extra you got here. These two, so they showed you an example in here. Percentage change in DOL, percentage change in EBIT. Okay, percentage change in EBIT. And here is another example they showed you here. So they showed you on the same thing. They showed you in using two different examples, two different equations. They got the answers. Okay, same problem, same equation, same problem. They use the difference. So quantity is given. Okay. So consider again actually the same company calculate the dole at the base level for 3,000, 4,000, 5,000, 6,000, 7,000 for model A and B. So they just showed you here only one. They showed you at 5,000. Okay. So there's a 5,000 units. We know P minus VC price is 50. Variable cost for mode A, variable cost is 40. They showed you one, they did one example and showed you how did they do it. Okay. All right. So for next one, financial risk and financial leverage. So in this time, we'll be talking about financial risk. Financial risk means that your business is in risk to pay off the financial expenses. Business is in risk that they will be unable to pay off the fixed financial expense, financial commitment, financial liabilities. What are the financial liabilities? Financial liabilities means, for example, let's say that, financial example, let's say that lease payment, interest expenses, okay? These are your tax liabilities, okay? These things are your financial liabilities, okay? All right. Now, how do we actually sort out the financial risk? It says yes, I told financial risk is the risk, interest rate, lease payment, preference share, dividends, dividends payables, these things. All right. Now let's talk about what is the leverage of these financial things. Okay. This is called their degree of financial leverage, DFL. Change in earnings available for ordinary shareholders. Okay, and here this is percentage change in EBIT. Okay. So percentage change in EPS, earning per share, divided by percentage change in EBIT. Okay. All right. The person, okay, and another example in here. These one also you can use DFL and no, should not. Oh gosh, I just selected, so it should not be board. This is another formula we have. So DFL, degree of financial leverage, is equal to EBIT divided by EBIT minus EBIT minus I, interest. Don't forget this. Okay, this is interest actually. Interest. I think I should write it interest. Interest expense. Okay. Since EPS, okay, so this is the formula they're using in here. So they're going to give you an example again to show you. So here is the example. Same example, same thing, same informations. Okay. I think the change is a little, okay, same company, but they added up a little bit more maybe. Suppose that in actual example, everything is unchanged except that the firm's asset with an assumed value of 200,000 are financed by 50% debt and 50% ordinary share equity with 500 ordinary shares on issue. The firm is assumed to pay 8% per annum interest on its debt. Calculate the DFL at the mode A. EBIT level is of 0, 10,000, 20,000, 30,000, 40,000. So they're actually asking you to show these 4 levels: 0, 10, 20, 30, 40. Okay. So if EBIT is this, what's going to happen? So now look at here. With 50% debt and 50% equity financing, and the interest rate is cost to pay is 8%. Okay, so they say the interest is $8,000 interest. Okay. $8,000 interest, it remains the same. $8,000 interest. So they subtract interest from the EBIT and they get the earning before tax. Then you pay company tax, 30% company tax. Okay, corporation tax is 30%. You make the payment for that. And the ending amount is earnings after tax. So earning after tax should be divided by your number of shares available, how many shareholders you have, number of shares issued. Okay. And divided by minus 11.2, that's your EPS. And DFL will be 0. Okay. Changes per change in EBIT is 0. Yeah. EBIT is actually, the next one EBIT is let's say 10,000. Okay. When EBIT is 10,000, then what happens? Then it becomes 5. How did they get interest 8,000? They said here, in this case, the firm has debt finance equal to half of the 200,000, 100,000, 100,000 into 8% into 8,000. That's what they got, 8,000 and 2.8. Okay, this is the kind of how many shareholders they have. This, I think they mentioned here that they have around how many shareholders. I'll show you. Give me a minute. Where is the shareholders amount? 50% ordinary shareholder with 500 ordinary shares on issue. Okay, so 500 ordinary shares. So 1,400 divided by 500, 2.8. Okay. That's how they got this figure. Here again, earning after tax. Tax is always, company tax is 30%. We know that. So this is 0.3 or 30%, whatever you say. Same thing. That's it. Now let's talk about total leverage. Total leverage is actually, total leverage, they actually multiply these two. Which two? DOL multiplied by DFL. What is DOL? Degree of operating leverage, and DFL, degree of financial leverage. Okay, these two. And what else? So here it is, DTL into DOL into DFL. Okay. Another example. This is another example you can see. This is another formula. This is another formula. Okay. And here is the same. The percentage change in EPS and percentage change in sales revenue. Okay. Here percentage change in EBIT and sales revenue. All right. That's the formula we have. Okay. You can use any of the formula, doesn't matter, to be honest. Okay. It depends on what information you have in your hand. So yeah, that's how you can do that. But anyway, so if you have percentage change in EPS, you have percentage change in sales revenue, that's it. You get this answer. If you don't have this, if you have these things, apply this. Depends on what information you have. All right, I want to move on to the next. Capital structure theories. So in this case, we say that in this case, we say this way. When you talk about capital structure, the capital structure generally refers to a mix of debt and equity. What percentage of your total capital coming from debt, means taking a loan from bank or wherever it is, and what percentage is coming as issuing your shares? 2. Okay, debt ratios. So we can actually get the 2 summary measures are commonly used to indicate a firm's capital structure. They tell you that how much is your debt ratio. Debt ratio is total liability by total assets. Okay, total liabilities by total assets. It doesn't work like that. Okay, that's fine if it doesn't work like that. All right. And other one, debt to equity ratio. Okay, the equation is long-term debt divided by equity. Okay. Yes. Or equity. So these 2 things. Now we'll be talking about theories, Miller-Modigliani theory. Okay. There is a question here. Does a firm's capital structure, its mix of debt and equity financing, affect its value? Okay. What is the optimal structure, optimum capital structure? What percentage is optimal? Optimum structure means what should be the percentage? What should be the debt ratio? What should be the debt to equity ratio things? That's what I'm trying to identify here. All right. Okay, now let's move on. So this says here, Miller-Modigliani capital structure relevant theory. Remember, irrelevance theory. We did these things in last class as well. Remember that he thinks that what is the dividend policy should not have any impact on the value of the company. That's what was his point. His point is, what is the dividend policy should not have any impact on the company's value. Yes. Okay, now let's move on. No, later. I'll do it later. No big deal. All right. So what should be our actual percentage? What proportion should be our debt and equity ratio? Okay, there is no answer for this question. It depends. It depends on the tax structure, depends on the tax shield, tax saving, depends on so many things. Okay. All right. So, Mr. Miller and Modiglen, what they said, the opposition, okay, this says they have some assumptions. They have some assumptions in here. Assumptions of the initial model, which was in 1958. That were the assumptions, and here are 3 implications. Okay. Okay, so the assumptions, we already discussed these assumptions in last week as well. Last class, you said that there is no transaction cost, there is no tax to be paid. These type of things he was talking about. And he also thinks the capital market is perfect, is very perfect, has no problem at all. Capital market is very perfect, but this is not very true. Capital market is not efficient. We have some problems in capital market. We have to pay the transaction cost. We have to pay the taxes on these things. Okay, this is the problems. Also, they think the company and the individual, they can actually borrow at the same rate of interest. They think like this. All right, let's move on. This is the assumptions they had. Okay. So under the assumptions, Mr. Miller Modigliani proved that capital structure would not affect the market value of a firm. It's their proposition. Okay. So 3 conclusions, the 3 implications, 3 conclusions they made in here. The conclusions are: work of a firm is independent of its capital structure. They think that work is independent. Work means capital asset, weighted average cost of capital. That is work. Okay, weighted average cost of capital. That is work. So they think that work is very independent. It has no impact, nothing to do with capital structure. Look, okay. Work is actually a combination of your debt, your preference share issue, and your ordinary share issue. It's actually the average of these 3, mean value of these 3. Okay. Regardless of the level of debt financing, work of a firm equals its cost of equity under 0 debt financing. So that's what they think here, that there is no debt. Okay, it's only the issuing shares. That's the situation he thinks. Okay. But it's not true. That's the problem. What he's talking about is doesn't match with the reality. Reality is very different. Okay. What else we have? Effect of, okay. No, nothing. I think I'll go to this one now. Okay, this is important one, and this is my topic. So another one is that tax on capital structure relevance theories. They say that the effect of corporate tax on capital structure that's classical tax theories they're talking here. Look, as soon as you take a loan from a bank or somewhere, you are actually enjoying some tax savings. Because 30% tax. We showed these things in last class on the tax shield, that how they are going to actually make some savings. If you have an interest payment, it means on that interest, which is actually your tax deductible. As a result, you don't have to pay taxes on this amount. So tax will be also decreasing on this amount. That's what they tried to say. They tried to say in here. Okay. And Here they showed you VL, value of financially leveraged firm, is equal to value of all equity finance firm plus all equity. All the money came from all the money that actually they have raised the capital, all the money came from issuing share. It's not, none of the money came from the bank as a loan. Okay. Yes. So this is under the classical tax system, company profit is taxed twice. Once the company level and again when they are paid out as dividends. In the context of original MM assumptions, if we introduce company taxation only at a statutory rate T, okay, and assume the firm's level of debt D, okay, and before tax cost of debt RD are constant in perpetuity. The original MM results that firm value of is not affected by capital structure changes to D. So they are actually multiplying here debt into tax rate. So they are actually, yeah, so that's what they mean. Like how much is your tax rate, that much you will be saving actually. That's what, but it's not 100% taxed. Another thing they did with derivation with corporate tax only, they will get the present value of the tax savings due to debt. This is actually present value of the tax. How much tax you're going to save in the future, you're going to actually make it present value of that amount. Okay. So they showed you here how did they calculate this value. Okay. T into RD into D divided by RD. So RD will be cancel out each other. So only TD will be left. Anyway, let's move on. This is nothing rocket science in here, to be honest. Yep. Okay, another thing, the effect of personal taxes on MM analysis. Personal taxes. Look, personal tax rate is in Australia, sometimes it's higher, sometimes it's lower. That's why we call it marginal tax rate. In reality, however, there are also personal taxes, and this should be taken into account when determining on firm's value. Okay? When determining the firm's value, you have to consider that part as well. And okay, nothing much. Yeah. Here also, okay, a dividend imputation and capital structure. It says here on this part, they will say this, under the dividend imputation system where all shareholders can use all tax credit company, like I showed you in last class, like franking dividend. Franking dividend means what percentage of tax, what proportion of tax has been paid by the corporations before they distribute the dividend to the shareholders. And when the shareholders receives that money, receives that dividend, they will check how much has been paid, and what are the rest of the amount they need to pay. That's the called imputation tax credit. Okay, you get a credit for the tax has been paid by the company on your behalf. Now I want to take you straight to this point. Here there are some interesting things they call agency cost is very important. Okay, and I also like to talk about financial distress. Okay. Non-tax reasons for capital structure relevance. This is not about tax. Tax other than tax. First on financial distress. The financial risk arises when firm borrows money, even the debt is riskless. Of course, if the business is in debt, there will be always risk. It's always risk. Debt is said to be risky when there is some risk of default. So, and in this case, they said in MM analysis, bankruptcy costs are assumed to be zero. No, bankruptcy has a huge cost. Okay. Now, this agency cost is the cost that when there is a conflict between the management and the shareholders. Management always, these are the four sources why they have the conflict for the four reasons. Number one, claim dilutions. This problem comes up because sometimes they take a loan from the bank and, you know, they will take loan from another bank too. As a result, the problem comes up, whom they're gonna pay first. Is one problem comes up. Okay. Second problem, dividend payout. They pay out a huge amount of dividend, increased risk faced by the debt holders, advantage of shareholders. Well, two things happens here, okay? If the managers see that they have taken the loan from a bank, they will pay big dividend to the shareholders. If they do not have taken any loan from the bank or anywhere, they will pay less amount of dividend to the shareholders. Yes, this game they play too. Asset substitutions. If they take the money if they have got the money from a loan, okay, they've taken a loan, and if the finance money coming from the loan, they will actually purchase risky assets. Normally, I mean the financial assets, risky financial assets they're gonna purchase. Okay, they're gonna purchase risky financial assets. But if they are not taking the money as a loan from the bank, they will not be actually going into the risky project. They always try to go for. Normally, management are actually risk averse. Underinvestment means that they don't want to make investment with a less profit. Profit is there, but not very high profit. They will not make investment. They'll keep the money with them. These are the problem, conflict between them. Between whom? Between the shareholder and the management agency problem. Also shareholders and the lenders. Okay. Optimum cash structure. How much will be your value of the farm? How do you calculate the value of the farm? EBIT into 1 minus T minus RA. RA is your WACC. Okay. Value of the farm is equal to value of equity plus value of debt. That's how they calculate it. And there's the formula they showed you. Okay, let me go straight to this point now. Merger acquisitions in here. There's nothing much in here. Most of the things you need to understand it, what they're trying to say. Different types of mergers available. Mergers are those when the two companies combined together, that's called merger. An acquisition means when one company take over another company, acquisition. See? Acquisition, when one company will buy out another company, that is acquisition. Merger means when they combine together. Two companies are combining together. It could be big, it could be small, doesn't matter. They're combining together. That is mergers. Okay. Yeah. And what else? Corporate restructuring. So the general term used to describe changes in the level of firm's operations or structure of its assets or financing. That's corporate restructuring. I mean, the firm's operation is restructuring, their management is restructuring, or their finances is restructured. Depends on what they're doing. The assets has been restructured. Depends. Next, merger. I told you. So they're trying to give you some terms that you need to understand. Consolidation. What is consolidation? Combine two firms together, two or more companies to one new company. That is consolidation. Acquiring firm, buying them out. Acquiring firm. The firm that is the object of a target company, which company you are actually buying out or combining. That's target company. Friendly merger. They come up together with the mutual interest, mutual benefit. They will go for a friendly merger. Okay, both the manager and shareholders of a target company approves of the merger. Friendly, they go it easily. Hostile merger, a merger that is resisted by the management of a target firm. That management do not like it that someone is taking over, but that is still being taken over. A strategic merger. Benefit from the economies of scale. So two companies are actually paying too much. Like in Australia now, you will find a lot of people, they actually become merging together to form their own self-managed super fund. three, four companies together, 3-4 people together, they manage their own fund because too much they're paying for the administration fees, government taxes, and everything. So they actually go for self-managed super fund. Okay, financial merger. These are a merger motivated by a desire to reconstruct the target firm's cash flows in order to achieve improved financial performance. When they see that, they're going to have a better financial performance, they will do that merging. If they feel like that, they can do it, yes. Reasons for merger, why do we want to merge? Only one reason, increase the shareholders' value. Shareholders' wealth is going to be increased. That's the only reason they're going to do it. Okay. First thing they do, diversification or growth, fund raising ability, management skills or technologies. One company could not do it by themselves. Two companies, like, let's think about this way. Now, if it happens that Motorola, Nokia, and who else? BlackBerry, they all come together, there will be a good margin. Then what's going to happen? They will have a technological dependency will increase. The fund will be increasing. They will have much more cash money with them. There are much more assets they have, much more, what should I say, patents they will have on themselves. That it will be better for them. Can they create one company who will be actually creating a new farm, new item will be coming up by company all this. They can do that, but I don't know whether they will be coming under one roof. I don't think so. Also, defense under unfriendly takeover. So if they also merge, they become too big that other companies cannot take them over easily. Okay, and tax benefit as well. Tax loss carry forward. Tax loss carry forward. If you have a loss in a business, you can actually carry it forward. Okay, so what do I do next? So these things are just, I'll say this one is like, now we're going to talk about different types of merger. Okay. Horizontal merger, vertical merger. Horizontal merger means when two companies from the same line of production comes together. That's called horizontal merger. Vertical merger, two companies coming together, but one is in a higher position than other, or two different levels. The level is not same. One is higher, one is lower, like this. Okay, like for horizontal merger, two retailers comes together, merging together and creating a new retail company. That is called horizontal merger. Vertical merger will be like when a retail company will be merging with a wholesale companies. That's good. Okay, wholesale is actually one level upper line than retail. So when the retail company will be merging with a wholesale company, vertically they are going. Okay, or a wholesale is merging with a retail. Okay, that will be vertical. Vertical can go up or down, doesn't matter. Horizontal remains the same line of production. And congeneric merger, a merger that involves two firms in the same general industry, but operating in different line of business. Same industry, different line of business. For example, in a car, okay, they are not competitive to each other. So let's say one is producing a tire of a car, another company is producing a screw of a car. So they are not in competition, two different things, but the same industry. Conglomerate merger, unrelated industries. So you see, horizontal, vertical, congeneric, and conglomerate. Horizontal is same level, same line of production. Vertical, different line of production. Conglomerate, same industry, but not competitive to each other. Conglomerate, unrelated industry coming up under one as a one. That's it. Now, leverage buyout and leveraged buyout and divestiture. Leveraged buyout and divestiture. I'll take actual divestiture first to you. Okay, let's do one by one. The leveraged buyout occurs when a small group of investors acquires a firm by using a high proportion of debt financing. This is a type of financial merger. Okay. So what happens? Let's say a public company is going to be purchased by a group of people, and they're purchasing it by taking a loan from the bank. So they're leveraging, they're making a leverage here. Okay, leverage ratio, like I tell you one thing, a leverage ratio is the ratio that tells you that what percentage of your capital is coming from the loan, or what percent is coming from the share issue. This is called leveraging. They are taking a loan and they're taking over a company. Leverage buyout. Divestiture. Divestiture means that they will be selling off the assets of the firm for cash money. They're not investing. Investment is they are buying something by paying money, cash money. But in this case, here different. They're selling the assets for cash money. Okay, I think I'll stop it here. That's it. And here, fundamental relation, what relationship they have, analyzing the farmer mergers relationship. The relationship is this: value of the merged firm will be equal to value of acquiring firm operating independently plus value of target firm operating independently. So one firm is operating independently. What is value of that firm? Another firm who has taken them over, before taking over, what is his value? Two value will become together. That is value of the merged firm plus the value of synergy. What is value of synergy? Value of synergy means this, that what these two firms could not do independently or separately, but being together now, they can do something separately. So they can do something not separately, they can do something together because they're combined now. This is known as value of synergy. Let's say Nokia and Motorola came together. Nokia had a nice screen, but they did not have a nice motherboard, for example, for a mobile phone. Motorola had a motherboard, nice, but they do not have a screen. If you combine these two, you can actually make a mobile phone, which will have different values. Independently, they could not do it, but together they can do it now after merging. And they could not do it independently before. For example, let's say patent right issues, they could not do it. But now they do not have that issue anymore because they both came together under one umbrella. That's the value of synergy, like combining together. Like you have expertise in something, your partner is expert in something else. So when you two becomes a partner, now you two can create something new that you could not do it independently before. That's called value of synergy. Okay. Oh my God, it's 8 o'clock. I got only half an hour more to go. Okay, let me finish off very quickly. Not workshop 14, workshop 13 today. 13 answers. I have to get workshop 13 answers for workshop 13. So these are we're going to solve now. Okay. Question number 4. Before I do these things, I would like to actually take attendance before I go ahead. Okay. I'll take my attendance first. Yeah. But I cannot take attendance on the screen because it's a problem of Privacy Act issues. So what I'm going to do is this. I'm going to put you on this screen, but I'll take my attendance in another way. So I'm going to take you to new share. I'm going to take you to answers for workshop 13. This one, share this. Yeah. And I'm gonna do your marking now, attendance marking, Dropbox. Attendance sheet. Okay. Is Timothy Smith in here? Timothy?
Yeah. Yeah. I'm here.
Thank you very much, Timothy. Junkai Wang?
Yep, I'm here.
Thank you very much, Junkai. Chuan Bak Jong? Chuan Bak? No. Yu Heng Lin?
Yes, I'm here.
Thank you. Liu Lai Fei? Liu Lai Fei? No. No, Liu Hui Fei Dong. I think Li Dong, right?
Yeah, Li Dong.
Yeah. Li Du, yeah. Jacob Labde?
Yes,
Thank
I'm
you.
here, sir.
Wei Jian Zhang? Wei Jian? Wei Jian, actually. Wei Jian Zhang. No. That's it. Oh, I didn't do the first. Oh, here. Daniel Bryan?
Yeah, me. Yeah.
Thank you very much, Daniel. Hyung Hom Cho? Hyung Hom Cho? No. Thomas Condell? Thomas? No. Oh, here is Lido is in here. Lido. Gurlin Kaur? Gurlin Kaur? Priscilla?
Yes, I'm here.
Thank you very much, Priscilla. Bahi Imam? Beha Imam? No. Welwin Kuriakoze? Welwin Kuriakoze? No. Ihan Lee? Ihan Lee? No. Benkata Saiposa?
Sorry, sir. It's Yu Honglin.
That's fine.
No.
Benkata Saiposa? Benkata is not here. Ananya Rizal? Ananya Rizal? Okay, one student I think I marked extra. That is Liu Hui Fei Dong. She's not here. Lidu, I have seen Lidu in Meghalaya. Okay. All right. Thank you very much, guys. Let me go back to our problem solving again. Not the workshop. We have to go. Okay, so now share screen. Share it. And this one we're gonna solve now. So the first question we have here is this. On Monday, 3rd of June, remember this one? This one is about like X dividend, this date, that date, these things. Okay? Yes. On Monday, 3rd of June 2013, the directors of Abco Proprietary Limited declared a dividend of 1.5 per share to be paid on Wednesday, 17 July 2013, with the date of record of Tuesday, 25 June 2013. Okay. So date of record is 25. Remember that. Declaration day is 3rd of June. Declared dividend, 3rd of June. Just before the date of declaration of the dividend, the firm had 20,000 shares on issue, cash balance of 200,000, retained earnings of 350,000, and no dividends payable. Determine the ex-dividend date. Ex-dividend date is 2 days before the date of record, so it should be 15th. Okay. Date of record, just because the date of declaration of dividend, firm return shares and these things. Determine the ex-dividend date, show the account value of the cash. Okay, we have to show this thing just before the declaration. Oh, they have something else in here. 3 points in time. Just before declaration of the dividend, just after the declaration of the dividend, and just after payment of the dividend. You throw these 3 things in here. So, okay. So it will be 2 days before the date of record is 25th of June, Tuesday, right? 2 days before that will be which day? Sunday. We cannot take Sunday. Okay. So it should be on which day? 2 days before Sunday. So if it is on 2013, can you see my calendar here? Can you see the calendar now?
Yeah, we can see it.
Okay, that's fine. So Tuesday, 25th of June. June 25th is Tuesday. So 2 days. Monday is 1 day. Sunday off. Saturday off. 21st. Make sense? 21st will be your ex-dividend date. Here we go. Ex-dividend date of Wednesday, Friday 21st. Ex-dividend date of, okay, so they mean here Tuesday 25th, so Wednesday 26th, so it will be coming back as 20. Okay. Anyway, now we have to show you here how our double entry works. Okay, this says here, when they will, before the dividend, just before the declaration of the dividend, this was the situation of the business. This was the situation of the business. Okay. Then what they do after this? They declared. Where as soon as they declare, it becomes payable. Okay. Dividend payable is 30,000 now. It's dividend payable. Look, they have a cash of $200,000. They return earnings of $350,000. They do not have any dividend payable. It means that they have no liability of that. Okay. So yeah, 30,000 is their debts. Oh, why is it like this? Okay. And after declaration, they will be changing. Now, dividends payable is 30,000, which they will pay from the retained earnings. Okay. And dividend is in there. Okay. And after the payment has been made, so after the payment again, dividend will be paid in full. It will become 0 now. Retained earnings will be 320. This amount will be paid by whom? By the cash. So cash is reduced by 30,000. Dividend payable is finished because they paid it off. That's it. Oh. Okay. Yes. This is number 4. Number 5. A firm has 800,000 in paid in capital. Do you guys have any question on this one, on debit and credit things, these things? Transfer of accounts, transfer money from the account. Do you have any questions on this one? No? Okay, I'll move them. A firm has 800,000 in paid capital, retained earnings of 40,000 including the current year's earnings. The retained earnings, a firm has 800,000 in paid capital, retained earnings 40,000 including this year's earnings. Okay, and 25,000 ordinary shares. So their capital is how much? $800,000 in paid in capital, and they have 25,000 ordinary shares they have, and they have $40,000 of retained earnings, including these years. Okay. In the current year, it has 29,000 of earnings available for the ordinary shareholders. So they decided they're going to pay up $29,000. Okay, 29,000 is available for them to give. Okay, what is the most the firm can pay in cash dividend to each ordinary shareholders? Okay, so what they're gonna pay? Okay, how much they can pay? So if they can even pay whole $40,000. If it is $40,000, they can distribute among whom? Among 25,000 shareholders. So 40,000 divided by 25,000, $1.6 for each. Okay. What effect would a cash dividend of 0.8 per share have on the firm's balance sheet entries? Okay. So if they pay 0.8 per share, so 0.8 into 25,000 shares, how much it will be? It will be, give me a second, 25,000 into 0.8, $20,000. So $20,000 they will have to pay as dividend payable, dividend liabilities. And how they're gonna pay it? Look at here, how they pay it. They pay from cash. In balance sheet, the money will be reduced from cash, and also it will be reduced from retained earnings. Look, 30,000 reduced from this both sides. Cash will be down, going down. Retained earnings will be going down too. So the retained earnings will be paid 40,000 minus 20,000, and cash will be how much cash they have. Did they mention how much cash they have? No, they did not. But the answer they said, the result of dividend will be 2,000 decrease in the cash and retained earnings. Yeah, that's what it is. 20,000 will be paid from the cash and the retained earnings. Okay. If the firm cannot raise any new funds from external sources, what do you consider to be the key constraint with respect to the magnitude of the firm's dividend payments? Okay. If the firm cannot raise new funds from external sources. If they cannot get money from other sources, what do you consider to be the key constraint? Key problems. There's a cash is the key problem, key constraint, because firm cannot pay out more in dividends than it has in cash unless it borrows. Nobody actually borrow and give dividends anyway. All right, next question is number 6. Nancy Lau currently holds 10,000 shares in Icicle company that supplies air conditioning systems. Icicle has issued a total of 250,000 ordinary shares and no preference shares are issued. The firm most recently had earnings available for ordinary shareholders 750,000 and its ordinary shares have been selling for this much. The firm intends to retain these earnings and pay a 10% share dividend. Okay. Firm's current earnings per share. What is EPS? Okay. So earning divided by number of shares. These are many ordinary shares they have. 250,000. And how much is their income? So Nancy has actually 10,000 shares in this company. Okay, 250,000 is the company's total ordinary shares. Nancy is one of the shareholder who has 10,000 shares. And no preference shares. The firm most recently had earnings available for ordinary shareholders. 750,000 is the amount available for them to distribute among shareholders. So 750,000 divided by 250,000, $3 earning per share. Okay. Ooh, ordinary shares have been selling for 34.3 per share. So their dividend is $3. Earning per share dividend they can pay, but the share price is 34.10. Wow. The firm intends to retain these earnings and pay 10% share dividend. They want to pay 10% from there. Okay, so how much Lau will get? This is what proportion of the firm does Nancy Lau currently own? So she owns 4% only. Okay, so out of 250,000 shares, she owns 10,000 shares. So 10,000 divided by 250 into 100. Yeah. Okay. So yes. Okay, now number C. What proportion of the firm will Nancy Lau own after the share dividend? How much she owns after the share dividends? Okay. So percentage ownership after share dividend. Share dividends maintain the same ownership percentage. They do not have a real value actually. Okay, it remains the same thing. It doesn't change actually. Yeah. And what this is, 10% share dividend. Okay. At what market price would you expect the Nancy Lau share to sell after the share dividend? So they are going to give a dividend of $3 dividend. They're going to actually pay in there. Okay. Expected new market price per share will be MPA is market price per share. Okay. Current market price plus how much 10% extra they are going to pay. They said here, right? The firm intends to retain these earnings and pay 10% share dividend. So 10% will be added up. They added up 10% in here. So I think you guys should actually really send an email to Reja about whether you are going to allowed to use the formula. I can see you guys need a lot of formulas to remember, and it's not realistic to remember these formulas. So I think they will actually allow you to have a formula sheet. Okay. Next. Suppose an individual subject to, oh wow. Suppose an individual subject to 30% marginal tax. So marginal tax means here the individual tax rate. Okay. Suppose an individual subject to a 30% marginal rate of income tax has 2,500 shares in a company that is paying a partially franked dividend of 40 cents per share. Or they give 40 cents partially. What percent is the frank? That's a good question. With a 70%. 70% franking ratio. So 70%. So 70% of their share is being tax paid. So if you get, let's say, $30 dividend, okay, 70% of it tax has been paid, right? So, and the question is, the individual is resident of tax purpose if the company is taxed 30%. So what tax credit can individual claim due to the partially franked dividend? The formula, yes. Dividend into TR divided by 1 minus TR into frank ratio. So your dividend is 40 cents is dividend into TR tax rate divided by 1 minus tax rate. Tax rate is here how much? Tax rate here is 30%, right? 30% tax rate. 1 minus 30, 70% in here into franking. So yeah, so the tax credit is $300 tax credit. So they have paid $300 tax, they have been paid. Now you have to calculate how much is their taxable income. How much is their tax supposed to be paid? So if the company has received, company has issued total cash dividend was given, $1,000 cash dividend was given. Why 1,000? How? 1,000, they said that they will be paying 40 cents per share and they have 2,500 shares available. Okay. This person has 2,500 shares available to him and 40 cents per share. So it means 40 cents into 2,500, $1,000 he's going to receive. And the company has already paid a tax of $300. Okay. So how much is his taxable income? Taxable income will be 1,000 plus 300, $1,300 has been his taxable income. So how much is the tax for $1,300? The tax for $1,300 is actually $390. How much company paid? 300. How much he needs to pay now? 90. Done. Yes. What tax, if any, is payable by individual out of the cash dividend payment received? Yeah, we showed you $90 cash he needs to pay. Okay, and this is the last one. Suppose a company pays out fully franked dividend $70 each to investors with marginal tax of 19%. The statutory corporate tax is 30%. How much tax will each investor pay his or her franked dividend? Okay, so the formula in here, dividend into TR divided by 1 minus TR, that's how you calculate your, how much is your dividends. Sorry, credit. Imputation credit for is $30. So gross of dividend will be 30 plus 70, $100. And its tax is actually $19. Okay, and the company has already paid 80. So, sorry. That $11, the taxable you'll have to return to him. That's it. Okay. Do you guys have any question to ask me?
No, thank you.
Anybody else? If you do not have any questions, you guys can log out. And don't forget to send an email to Reja and CC to me. It should be fine. Yeah, so both of us knows that you guys are looking for this answer, this thing for these questions, and definitely we'll do something. Okay, I'll end up the meeting now. I'll stop the recording.